Welcome to this lecture on the business tax issues of Budget 2021. Now, we are going to cover certain areas in more detail next month when we cover the finance bill, but we're going to look at all areas of the budget, and then next month, finance bill, certain areas we're going to look at in more detail. My name is Dean Wootten. First up, let's look at the Self-Employed Income Support Scheme, fourth grant. Now, the fourth grant will cover February through to April 21 and will be 80% of 3 months' average profits with a maximum grant of £7,500. So that seems that it's the same as before, but the eligibility will be different. Eligibility will initially be based on your submitted 2019-20 return. They're looking at trading profits being under 50,000 and at least equal to your non-trading income. So that bit's the same. But they're looking at 1920. So previously it was always 1819. So recent startups didn't qualify. But now they're looking at 1920. Some clients will be eligible for the fourth grant when they weren't eligible for the first, second or third. Now, if you're not eligible based on your 1920, they will then look at the average over 4 years, 1617 through to 1920. Now, you must have traded in 1920 and 2021 and have submitted the 1920 self-assessment return by the 3rd of March 21. Other than that, the declarations are pretty much the same. So you're impacted by COVID, intending to trade. So we will have situations where clients didn't get the first, second or third, but are eligible for the fourth and vice versa, because they're now looking at more recent years as well. So it might pop your income over 50,000, whereas before you qualified, but now they're looking at 1920, you don't. So there's going to be winners and losers under this new way of calculating the fourth grant. Now, the fourth grant will be available late April. Now, the fifth grant is going to cover May through to September 21. We can claim from late July 21, but this time they're doing it based on how much you've been affected. Now, if your turnover has fallen in 2021 by 30% or more, then you can get 80% of your average profits with a maximum of £7,500. If your turnover has fallen in 2021 by under 30%, then you get 30% of the average profits with a maximum of £2,850. And it is a cliff edge effect. So if you are 29%, say, then unfortunately your grant's just dropped from maximum 7,500 to maximum £2,850. Now, further details are expected in due course, but I'm just looking at this and I'm thinking you might well be busy. Because they're looking at turnover falling in 2021, but we're claiming in July 21. So if we're using MTD compatible software, for example, then obviously we know whether turnover has fallen or not. But not all clients are using that type of software. So we will have to know how much our turnover has fallen. But as I say, more details expected on that. They've also got clarification on when SEIS grants are taxed. Now, the Finance Act 20 said they'll be taxed in 2021, effectively in the year of receipt, but they were just looking at the early grants, so grant 1, 2 and 3, which would have been received in 2021. Now, because the law actually says taxed in 2021, then they've got to change it, because they want it to be taxed when received, but obviously the fourth and fifth grant won't be received until 21-22. So SEIS grants will be taxed when received. So grants 1, 2, 3 in 2021 and grants 4 and 5 in 21-22. Now, what that shows me is that we shouldn't really be including the grants in the accounts. Because we might get the wrong answer if we include it in the accounts. So I'd be excluding them from my actual accounts. And I'd be expected to put them separately on my tax return for 2021. And this would kind of stack up with the thought process for the fifth grant, because you're looking at turnover falling. So if I don't really want my SEIS grant to be in my turnover, and I don't think it should be. I think you should be leaving it out of your accounts and bringing it in as a separate entry on your return. There might well be a box for it. So in 2021, my 1, 2 and 3 grants will be recorded separately. And then also in 21-22, I'm going to have, hopefully, the fourth and the fifth grant. So class 2, no massive change to this. Okay, the profit threshold's gone up a little bit. The rate per week is unchanged at £3.05p per week. It is great value, class 2, because you get this index-linked pension of around £9,100 per annum. Now you'll need a pension pot, of between 350 and 400,000 to buy a pension like that. So I think it offers good value. And also the pension pot, the state pension pot, doesn't count towards the lifetime allowance because you haven't really got a pot, you've just got a state pension. So it's best to continue paying class 2, even if during COVID, for example, your profits might fall below 6515. It would be still worthwhile carrying on with your class 2 because you are securing quite valuable state benefits. The state pension, I think, being the most valuable. Class 4, subtle changes, lower profit limit 9568, upper profit limit 50270. Both limits will be frozen until April 26, which is good news for the upper limit, and the rates are still 9% and 2%. Apprenticeships for hiring between 1st of April and the end of September. The incentive payments for hiring new apprentices increases from £1,500 to £3,000 per person. And we have supplements. This supplements the existing £1,000 payment for 16 to 18-year-old apprentices and those under 25 with education, health and care plans. So again, trying to incentivise employers to take on apprentices. Quite a lot of tax breaks. Not only will they pay for training and stuff like that, but you're also getting incentives, cash incentives. Corporation tax rates. Well, this was one of the big headliners. So from the 1st of April 23, we'll pay the small company rate for profit up to 50,000, but we've got a main rate of 25% for profits above 250,000. The marginal relief for profits in between is 3/200ths, which gives us a marginal tax rate of 26.5%. I'll look at how we arrive at that in a moment. So going forward, I think there's going to be planning around avoiding these higher rates, especially the marginal 26.5 if our profits are 60 or 70,000, say. Now, these limits, the 50,000 and the 250,000, are apportioned for short accounting periods and, most importantly, associated companies. And we'll look at that separate. Give an example. So, formula for marginal relief is as it was a few years back. Upper limit, which is the 250, minus profits, times basic profits over profits, times 3 over 200. Now, I think in most clients, basic profits and profits will be the same number. It's only when you've got dividends coming in that they'll be different. So corporation tax on profits of 90,000 in the year to 31st of March 24 will be £20,100. That's 90,000 at 25%, 22,500. Take off marginal relief of 2,400, which is 250, upper limit, minus profits, 90. Times basic profits over profits, so I think that's 90 over 90, times the marginal relief fraction of 3/200ths. Now this gets you down to a corporation tax liability of £20,100. Now the software will do this, and I think our understanding is more for planning purposes. So it's the same as 50,000 at 19% and 40,000 at 26.5%, which will give you the same 2,100. So if we can affect that 40,000, then we are giving our clients relief at 26.5% going forward. For example, corporate pension contributions. They're a useful planning vehicle, and that is going to be, I think, very useful going forward, because if I've got clients that are doing low salary, high dividend, let's say they've got a personal allowance salary, then their own contributions are restricted to their own salary, but the company contributions are not. So therefore you might want to pay a 10,000 corporate contribution or a 20,000 corporate contribution. Now let's consider £60,000 of pre-tax profit for the year to 31st of March 24. A corporate contribution of £10,000 would have £2,650 worth of corporation tax relief, 26.5% marginal relief. Now the added benefit is a really low rate of extraction, because there's no tax on, so I've got £10,000 in my pension pot. Now when you get to pensionable age, 55, there will be no tax on 25% of that fund, so you just draw it as a tax-free sum. So let's say the fund remains £10,000, so I just take out £2,500. Now I'll draw the balance as income. and I'll be a basic rate taxpayer when I'm drawing the balance. So let's say that's 20% on 7.5, so that'll be £1,500. That's the only tax I paid on getting my money out of my pension. So that's 15% tax rate on a £10,000 extraction. But don't forget, you had 26.5% going in. So that's a negative tax rate. It's always been negative tax rates, corporate contributions, but with a corporate rate of 26.5%, then you're getting over, 11.5% negative tax rate. So i.e. the government are almost encouraging you to do this. Now, the definition of associated companies has changed, unfortunately. Now, the new associated company definition replaces the current 51% group companies definition. Now, under the new rules, two companies associated if at any time within the preceding 12 months, one company has control of the other, which is like the current rules, or both companies are under the control of the same person or group of persons. That's the change. Now, these rules were used for the 50k and the 250k profit limits from April 23, and anywhere else where we're currently using the 51% group definition. So, corporation tax by instalments, for example, you'd be dividing your 1.5 million by the number of associates. Now, this change has far-reaching impact on our clients, because some clients might own one or two companies personally. Now, they will be associated under these new rules, so the limits you'll have to be dividing by the number of those associated companies. So whilst 50k to 50k seems decent, if you've got three companies owned by the same person, then you divide those limits by 3, and you'll be into the marginal rates much quicker than you thought. Now, another headline grabber was the extended loss carryback. Now, companies and unincorporated businesses can extend the carryback of losses under 2 million to the second and third previous years on a LIFO basis. Now, for unincorporated businesses, it applies to the losses of the tax years 2021 and 21-22. Now, we can carry back a year anyway under normal rules. What this does, it extends it by another 2. For companies, it applies for accounting periods ending between the 1st of April 20 and 31st of March 21. That's your first year. And then 1st of April 21 to 31st of March 22. But again, second and third on a LIFO basis. Now, the extended corporate carryback seems to be against total profits. There does seem to be an error in the HMRC guidance on this. The Finance Bill definitely says total profits, but the carryback for unincorporated businesses is against trading income only. But you've got to be careful with this because, yes, the relief, you can go back further than before. But if you're a corporate, then if you carry the loss forward, it'll be worth more. So 25%, or maybe even 26.5%. So it depends if the company really needs the benefit of that carryback from a cash flow perspective. If they don't, then it might be better to sit on it and just carry it forward because you know there's higher rates coming for corporates. Capital allowances, so changes there as well. Now, for capital allowances, corporates spending between the 1st of April 21 and 31st of March 23, we have this new super deduction. And that's on new and unused plant and machinery that would be eligible for the 18% or 6% pools, not cars though. And it's noticeable that it must be new and unused. It's not like the AIA, which could be second hand. For the super deduction, you have to have new and unused. Now, for plant and machinery that was eligible for the 18% pool, there's a 130% deduction on cost, the super deduction. For sales in accounting periods ending before 1st of April 23, proceeds on disposal are grossed up to 130% and treated as an immediate balancing charge. You don't net them off against the pool. Now, that is, I don't think we're going to see that very often. I might be mistaken, but you've got to be buying the asset and selling it pretty quick. So, you can't buy the thing, get the super deduction until April 21. And if you were to sell it before 1st of April 23, then you've got to gross up the proceeds by 130%. Now, this super deduction of 130 reduces to 50% for plant eligible for the 6% pool. But again, I don't think we'll see that because the AIA is still here. It's £1 million for 21, and therefore the AIA should be used for those 6% assets, not the 50% super deduction. Now, there are some anti-avoidance on this. So contracts must be from the 3rd of March 21. So if you were planning or you contracted before that date, then unfortunately you don't get the super deduction. Now, I'm imagining there's going to be lots of businesses just waiting. They won't be spending in late March because there's no point. You'll be waiting until the 1st of April to spend and get your super deduction. Let's look at an example. So I've got a company, contracts a plant and machinery on the 10th of April 21, acquires it on the 31st of May 21. The cost is $300,000, so all good. The corporation that's saved in the year to March 22 will be £74,100. That's a super deduction, 300,000 times 130%, so 390, multiplied by 19%. So that's 74,100. We could have claimed AIA because that's still around, but that would have saved tax of 57,000. So the increased tax saved by way of the super deduction is 17,100, which is 300,000 times 30%, times 19%. So it's temporary super deduction. If that item is then sold in the year to 31st of March 23 for $220,000, and the proceeds have to be grossed up by the same 130%, so they become 286, and you have an immediate balance in charge of 286,000, on which you pay corporation tax at 19%. Now, I don't think we'll see much of that, buying and selling in consecutive years, for example. Now, it gets rather bizarre when you do sell, but you sell it in an accounting period which straddles the 1st of April 23. So consider a year end of 31 December. Now, in the year to 31 December 22, plant of 500,000 is acquired, and there's a super deduction of 650,000. There's no upper limit on this super deduction. So 650,000, that's 500,000 times 130%. The plant is then sold for 350,000 in the year to 31st of December 23, a year which straddles the 1st of April 23. Now, the proceeds are brought in at 379,750 for balance in charge purposes. That's 130% times 3/12. That's the bit of the year that fell before the 1st of April 23. And then 100% times 9/12, which is the after April 23. Now, that gives you an effective percentage of 107.5. And I've got to multiply my proceeds by that to find out my deemed proceeds on which I'll pay a balance in charge. Now, the reason this is there, I think, is to reduce the impact of the 25% corporation tax rate from the 1st of April 23. It would be quite a hit if you had to bring it back in at the 130, say, and you'd be paying a higher rate of tax as well. So I think that's why they're there. If you're fully outside of April 23, or you're not straddling, then obviously you're just bringing in the proceeds. Well, let's look at indirect taxes. Not a lot on those. Now, as I'm sure you're all aware, the 500,000 nil rate ban has been extended to the end of June 21. It then drops to 250 for 3 months, and it goes back to the old 125,000. There's going to be a 2% SDLT surcharge when non-UK residents purchase residential property in England and Northern Ireland, coming in from the 1st of April 21. ATED rates, minor increases. And I mean minor, really, really small. VAT changes. Well, thankfully, the VAT registration limit is frozen at 85,000 until April 24. I think that's a positive because I can only ever see that reducing going forward. So keeping 85,000 is a positive. The 5% hospitality rate remains in place until September 21. It then goes up to 12.5% for 6 months, and then it revert back to the old 20%. Now, pubs, restaurants, etc., they won't be reducing prices. They're all keeping the prices the same, and they're just keeping more of the money, which is fair enough because they've been really struggling. So we're just applying a lower VAT fraction, and that would increase profits. Just be careful with this because if you've got clients, let's say we do get hopefully open fairly soon, and you've got businesses having staff functions just to get together once again, and you're paying for staff meals, etc., then don't deduct 1/6 from the cost, obviously, in terms of VAT recovery, because the pub or restaurant hasn't paid 1/6, and because they're using the 5% hospitality rate. So there will be a sixth on things like alcohol, but pretty much everything else will either be at 5%. I don't think it'll be on 0 if you're eating. Well, it won't be. So it'll be 5% or 20% when you're sitting down to eat. So don't just take 1/6 of your spend. Look at what the bill is for. Some of it will be at 6th, the alcohol, but the rest of it should be with the VAT fraction for 5%. The other point to note on this is that the flat rates will also be adjusted from the 1st of October 21. I haven't seen yet what they'll be, but flat rates will change when it goes back to 12.5% and then again to 20%. Now, with the flat rates, just be careful, because your flat rate is your predominant source of income. Now, a lot of the pubs are starting to focus on food because they realise that's where they need to be to make money going forward. Now, if they get more money from food than they do from the pub bit, like the beer and stuff, then they are now a restaurant, and they should be using the restaurant flat rates rather than the pub flat rates. So that will be announced fairly shortly, what the new flat rates are. Well, that concludes the budget lecture, Business Tax Issues. My name's Dean Wootten. Thank you for listening.